You can see here, this was the nature of it. It started in 2001 and gold started to move higher relative to the S&P 500. And then it stayed around that level for about 2.5, 3 years. That's not gonna be that long this time. We're going at a much faster pace. And then it climbed again in 2006 and flirted with the 50-week moving average again in 2006, 2007. Another move up here, touched the 50-week moving average, a huge move up into the 2008 financial crisis. And then it danced around the 50-week moving average again twice before moving up in the final move of the bull market into 2011. So going back to this chart, I think this is the beginning of this bull market relative to the S&P 500, or the big move part of it. So we have the first move here. We're going to go back somewhere near the 50-week moving average and then move up again. And we're not going to be able to time these little waves.
Monetary analyst Rafi Farber is identifying striking parallels between today's gold market and the historic bull run of 2001 to 2011, centered on the behavior of the gold-to-S&P 500 ratio. This critical indicator is currently retracing gains while holding above its 50-week moving average, mirroring the technical pattern observed during the early stages of the previous decade-long rally. Gold has recently achieved record highs across multiple currencies, but today's rally differs fundamentally from its predecessor. While the 2009 to 2011 surge was primarily driven by quantitative easing and post-crisis inflation fears, the current uptrend reflects more diverse economic foundations and broader monetary policy uncertainties. The technical breakthrough occurred in March 2025, when the gold-to-S&P 500 ratio broke through a 4.5-year support base, triggering substantial gains in the precious metals sector during the first half of 2025. Historical data shows such decisive breaks below primary support levels often precede multi-year gold bull markets, lending credence to the current setup's significance. Farber believes we are in the early phase of a larger move, expecting a brief pullback toward the moving average before another leg up. Given the difficulty of timing short-term waves, he advocates a simple strategy: continuous accumulation rather than tactical trading. Historical precedent supports this patient approach. Gold bull markets typically last 5 to 10 years from breakout to peak. With gold's breakout occurring approximately 1 to 2 years ago, we appear to be positioned in the early to mid stages of this potential cycle, suggesting that significant upside may remain if historical patterns hold. Before we begin, don't forget to like, share, comment, and subscribe. Hit the bell icon to stay updated with our latest market insights and timely updates.
Beyond that, we're going to talk about the similarities now between the previous gold market of 2001 to 2011 relative to the S&P and what is happening now. It looks like we're retracing some of the gains relative to the S&P gold to S&P 500 ratio, but we are firmly above the 50-week moving average, which is what happened basically in the 2001 to 2011 gold bull market, and we seem to be on a repeat trajectory, except everything is going to happen faster this time because there's so much more monetary fuel in the system. And finally, for the first time in years, Newmont, the worst performing gold stock probably ever, maybe, or the biggest one too, the most disappointing, is finally breaking out, up I think 6% today on an earnings beat, an impressive one, but one that shouldn't be surprising given gold's price. And if Newmont is breaking out, the rest of the gold mining complex should follow, or already has been. If Newmont can catch up, you got everything running on all cylinders except for Barrick. We'll see what happens with Barrick. But anyway, on to this week's silver report, really gold report, brought to you by Silver 47. Silver 47, symbol AAGAF in the US, symbol AGA in Canada, continues to move with the silver price, up and down with the silver price more or less. So this could be seen as currently a proxy for silver. Goes a little bit more volatile than silver itself, of course, because it's a silver explorer. You can see here that it has been moving up with silver and slightly down as the wobbles continue here. Same thing in April down here when we had that this micro silver crash back in that month. And it continues to go on its merry way. Okay, so something specific is going on in gold, in the gold market relative to the COMEX. You can see here that I highlighted 4 delivery days. These are the delivery totals for gold this month for the July contract. So you can see here that these these are the 4 biggest delivery days outside of first notice. I took out these first 4 days because that's when there's a big front loading of deliveries from the previous month, from previous month's longs. So these, when you're moving to the middle of the month, usually signify traders that are buying spot contracts in the spot month and taking immediate delivery on them. That's why there's these elevations in these specific days. You can see that's exactly what happened here on July 24th. These are the numbers for July 24th, the last data that we have available. You can see here that in the spot contract, we had an increase of 1,072 contracts. That means that all of those 1,072 contracts are being bought within the delivery window. So whoever goes along those contracts is doing it for delivery, or at least they're risking it because they can be called to get delivery at any day. And you can see here that there was a huge spike in deliveries on July 24th. This data is always one day behind this data. The deliveries happen and then reflected here on the day before. So you can see 962 deliveries. So why am I highlighting all these? Because if you see, we have the dates, July 8th, July 14th, July 17th, and July 24th, the 4 biggest delivery days outside of the delivery window for the previous month up here. And you have this. I took these little rectangles. These are the 4 days of the 4 biggest deliveries. You can see the top 4 delivery days for gold in July were all serious down days for gold itself. So we're seeing on big down days in the gold price, or relatively big down days in the gold price, we're seeing huge spikes in deliveries. So whoever is taking advantage of these little dips in prices, using them to accumulate gold warrants on the COMEX. So warrants are going to be held for a while. These are strong hands that are getting warrants to hold the gold itself. I don't think they're loading out of the COMEX specifically, but they are holding on to the warrants, which tag themselves to one 100-ounce gold bar each. Basically, what I'm saying is that some traders, big traders, are using the downticks to accumulate physical gold in the form of warrants. I just wanted to go a little bit into the current nature of the bull market relative, the gold bull market relative to the S&P 500. We can see here that we had a spike in gold prices relative to the S&P 500 to about 0.64. Now we have retraced to about 0.53, but we're still comfortably above the 50-week moving average. Now, what I think is going to happen, I think we're going to stay around the 50-week moving average, maybe for a while, maybe for a few days, maybe a week or two, and then we're going to head up again higher. So why do I say that? Because this is the previous gold bull market, gold relative to the S&P 500. You can see here, this was the nature of it. It started in 2001, and gold started to move higher relative to the S&P 500, and then it stayed around that level for about 2.5, 3 years. That's not gonna be that long this time. We're going at a much faster pace. And then it climbed again in 2006 and flirted with the 50-week moving average again in 2006, 2007. Another move up here, touched the 50-week moving average, a huge move up into the 2008 financial crisis, and then it danced around the 50-week moving average again twice before moving up in the final move of the bull market into 2011. So going back to this chart, I think this is the beginning of this bull market relative to the S&P 500, or the big move part of it. So we have the first move here. We're going to go back somewhere near the 50-week moving average and then move up again. And we're not going to be able to time these little waves, so I just keep accumulating and stacking anyway. Finally, I wanted to talk about Newmont in the context of the gold to the Huey ratio. The Huey is an index of gold mining stocks. We can see here that the lower this ratio goes, the higher gold stocks are priced relative to gold. So the higher this is, the worse gold stocks are doing relative to gold. So we want this to go lower. And we see here that we are below the 50-week and the 200 moving average, but we're still nowhere near where we were in 2012, which was around below 3. Now we're at 7.65. So if we get back to this number in 2012 at the end of the last bull market, which I expect that we will, we're going to see gold stocks triple relative to gold. And we see this starting to happen in Newmont. Newmont had a huge day, up 6% today because of an earnings beat. But we see here that we were down to about 25 in 2022, and now we're up to 51. This is, again, the ratio relative to gold. So the lower it goes, the higher Newmont is priced relative to gold. So basically, Newmont could double relative to the gold price from here, and we'd still be at this number in 2022. That is not that long ago, and the market has not changed so fundamentally since then. I think we're going to head into that, around that number. So we're going to see Newmont continue to outperform here. I think it might finally be breaking loose, and it has been horrible for many years. If you zoom into the gold to Newmont ratio here, we can see that on a long-term, actually a yearly basis going back to 2022. This was when we were at 2025 at the high here, when I think the stock was at 74, and gold is much higher than it was back then. So we're going to see big moves in the stock, I think. We're here below the trend line, which is good because the lower this ratio goes, the higher Newmont is relative to gold. We've finally broken this trend line, which was established in 2022 and 2024. We should be on our way down. Long term, or however long term is before the end game actually hits, which might not be so long actually, if we're talking about September 15th as the beginning of the final sprint.
Rafi Farber regularly examines the financial systems, plumbing, the funding markets that keep global finance operational, drawing insights from Bloomberg's Alex Harris, his preferred source on these complex mechanisms. Harris's recent piece warns of tightening liquidity and its potential impact on Fed funds rates, prompting Farber to provide crucial context through the lens of recent history. The most telling example is the September 2019 repocalypse, when repo rates suddenly spiked above 10%. Farber clarifies that this wasn't caused by the Fed's balance sheet reduction program itself, but rather by bank reserves falling much more sharply than expected. This reserve shortage created a liquidity crisis that forced immediate Fed intervention. The crisis's aftermath proved significant. It ended the Fed's balance sheet normalization, triggered the return of quantitative easing, and ultimately paved the way for the massive monetary expansion during the COVID era. The technical details reveal how quickly funding stress can escalate. By mid-September 2019, aggregate bank reserves had hit a multi-year low of below $1.4 trillion, while primary dealers held record-high treasury positions. These reserve constraints on banks and affiliated dealers contributed to the repo spike, demonstrating how regulatory and operational factors can amplify market stress. When banks lack sufficient reserves while facing an elevated treasury inventory, the funding squeeze can create severe market dislocations. Let's get back to the video.
Now, we're going to get into the plumbing here because this is really interesting. These are excerpts from a Bloomberg article published yesterday by Alex Harris. She's the main plumbing correspondent that I follow on Bloomberg. She writes the most interesting articles, in my opinion. It says here, the risk of tighter money sparks debate over the Fed funds rate. We're going to read this whole thing. These are excerpts, and I'll explain the paragraphs as I read them. Funding turbulence is common and occurred last in 2019, talking about the September 2019 repocalypse, when repo rates went above 10% in some instances, when the Fed quickly reduced its balance sheet to just under 1.5 trillion. That's actually a mistake, a typo, or an error of hers. She means 1.5 trillion in bank reserves, not 1.5 trillion total. But anyway, unknown to policymakers, bank reserves had grown scarce, leading the Fed's move, combined with Treasury auction settlements and anticipated corporate tax payments, to cause a surge in a key lending rate, many key lending rates actually, as well as Fed funds, forcing officials to intervene. That was the apocalypse. That's when QE restarted and eventually led to the COVID printing, which was either caused by the COVID lockdowns or it was planned. I don't know the answer to that, and I don't think anybody ever will, just like Epstein. Whatever. This time around, bank reserves stand at an ample 3.38 trillion. Now, here's her first mistake, or second mistake. The fact that she says ample, and because they seem to be more than twice the amount of bank reserves from the last apocalypse, that would make you think that they are actually ample and there's plenty of room here, but there isn't, because most of that 3.38 trillion is being used to trade the basis trade in futures on US Treasuries. They're all being tied up in that because that's free money for the banks, and they keep doing it over and over and over again, leveraged about 50 times. According to some estimates, that means they borrow the repo money by pawning off Treasury securities, and then they have that repo money to buy more Treasury securities and pawn them off for more repo, et cetera, 50 times over, and that's how they make their free money. But anyway, we continue here. Fed Governor Christopher Waller said earlier this month they could be allowed to fall, meaning bank reserves could be allowed to fall to 2.7 trillion. We went over last week. I'll put a card here in the corner in last week's silver report that is ridiculous, because the amount of money that's being traded in the repo market is more than $2.7 trillion a night and continues to be above that level. So it can't fall to 2.7 trillion. That's crazy. For strategists at Bank of America, we continue, there's still a risk of increased funding pressures in September. Now, the Treasury Department is targeting a slower rebuild of its cash balance. So what he's saying here is that the Treasury is raising money, raising debt, are selling debt slower than they otherwise would because they don't want to cause a clog in the repo market. And we have seen that despite the rise in the national debt, there hasn't been no significant rise in the cash balance at the Treasury, which means they're being very careful in sucking money out of bank reserves to spend on whatever it is they spend it on. Next paragraph. They said in a recent report that the risk arises because usage of the reverse repo facility, a barometer of excess liquidity, which we cover here often, is expected to be close to zero by then. So by September, it will be zero. Why will it be zero? Because the Treasury has to raise money since the debt ceiling was raised, and it raises money primarily by sucking it out of the reverse repo facility. And they do that by replacing reverse repo cash with treasuries that are sold to money market funds, and they give the Treasury cash, which they spend on government spending, whatever. So what is the key that's going to happen on September 15th? Right? It is expected to be close to zero by then. We continue with tax payments on the 15th, meaning the 15th of September of the month, September, and coupon auction settlements, which means that Treasury auctions that settle on that date will drain more liquidity. The same conditions that we saw on September 17th, 2019, except this time with twice as much bank reserves, but all of which are being used in the repo market. And if the repo market and the Treasury are fighting over the same dollars, the Treasury will win and rates will spike. Last week's Fed minutes also acknowledged expected outflows. Final paragraph. Now, this might seem technical, but I'll make it really simple. To be sure, Wrightson's Crandall said that while it's unlikely that future declines in bank reserves, will have a material impact on the Fed funds rate, it can't be ruled out that the rate starts to creep up within the current range. Now, here Crandall's talking about something that's completely irrelevant. He's talking about the federal funds rate, that the rate that the Fed directly controls, which is barely traded anymore. It's like $100 billion a day, which is nothing compared to the SOFR, which is the repo rate, which is like, closer to $3 trillion a day, which is like 1/30th the size, the Fed funds rate. But anyway, Crandall has argued that the tri-party general collateral rate, or the TGCR, and another repo benchmark overseen by the New York Fed would be an ideal Fed funds replacement, as that is where financial institutions really lend cash. He's saying the TGCR and this other rate are much better at gauging tightness in the monetary system, and he's right because of this. We can see here, this is the effective federal funds rate versus the SOFR rate, the secure overnight financing rate, the rate that I follow very closely to determine when the next repocalypse is going to happen, or the next monetary tightness event or crash or whatever it's going to be. You can see here that the blue line here is the effective federal funds rate. That's what the Fed directly controls. But here is the SOFR overlaid on it. Usually it's right around the same rate, but you can see here, this was the repocalypse when these dots went up significantly and the Fed funds rate did not, because most of the money being traded is in the SOFR market and not the Fed funds overnight market. And here is the basic math. The rate that this guy Crandall says that he wants to follow is the TGCR, but basically the SOFR is the TGCR plus the BGCR. Don't worry about what all these stupid things mean. They're just different forms of overnight rates collateralized by treasuries, and the SOFR is all of them together, which is why I follow that. And now we have this article in Bloomberg where some officials are considering maybe following a different number because the Fed funds rate is so irrelevant. Well, I follow that number. I have noted, and I put this almost in every silver report, which is really the gold report this week, that this is the amount of bank reserves being used in the SOFR market by proportion. We're still above 80%, and we can expect this number to spike possibly to 90% or higher on the month turn, which is going to happen next week. It's now July 25th, so in 7 days, it will be August 1st or August 2nd. And that is going to be the monthly turn, and we always see a spike in the ratio here. The last repocalypse happened around here at 83%. We are right at that level now, and the next spike, it might be cleared up, but once we get to the 15th, which is what the Bloomberg article was talking about, we could see finally the last repocalypse. Now,
silver and gold continue to reflect deeper and growing strains within the financial system as hidden liquidity risks resurface and funding markets become increasingly fragile, with mounting pressure on bank reserves, heightened reliance on leverage, and several critical liquidity events approaching, such as tax payments, Treasury settlements, and reverse repo depletion, the stage is set for renewed financial volatility. Despite official narratives of stability, the underlying mechanics point to systemic stress that cannot be ignored. As confidence in traditional monetary tools and fiat mechanisms weakens, silver and gold are poised to regain prominence, not only as inflation hedges, but also as essential, strategic stores of value in a market environment that is becoming increasingly unpredictable and unstable by the day. Is gold preparing to lead the next financial shift? Share your thoughts in the comments below. If you enjoy this video, don't forget to like, share, and subscribe. Hit the bell icon and turn on notifications to stay updated. Your support helps us continue delivering the latest market insights to you and the entire community. Thank you for your support.